Well, as investors eye stocks warily amid rising interest rates, the question is whether to play it safe or to bet that markets are bottoming out. Our next guest is firmly in the second camp and says disregard the rate scare and buy stocks now. To explain why, joining us is Alec Young, Chief Investment Strategist at MAPsignals. Alec, thanks so much for making time for us today.
Great to be here. Thank you.
So it does seem like there is some buying happening out there today. North American equity markets are in the green this afternoon, but we're heading into earnings season. How do you think that could potentially influence things?
I think earnings are likely to be a positive catalyst in the U.S. So we've had several quarters of declining earnings, and the expectation is that that trend is going to reverse this quarter. We'll finally see earnings starting to grow again. Another factor I think that plays favorably for earnings is, given all the macro uncertainty, anyone who really wants to sell stocks based on disappointing earnings has really had a chance to do that. We've had a pretty nasty pullback in the U.S. since late summer. So I think the setup is always better for stocks when people's expectations are low coming into the earnings season. And results are likely to kind of exceed that low bar. And that's certainly what we've seen early on here with Pepsi, JP Morgan, and some of the other early reporters that we've heard from so far.
We've got a couple of charts of yours, Alec, that I want to go through. And one is looking at a Goldman Sachs U.S. Financial Conditions Index and showing how it moves inversely to the S&P 500. Can you walk us through what this is illustrating?
Sure. Well, what we've seen since the summer is tightening financial conditions in the U.S. That's just a fancy way of saying that interest rates have been going up, the dollar's been strengthening, credit spreads have widened, stock prices have pulled back. All these things tighten financial conditions, and Goldman has a great index that encapsulates all of that. And what we show in our chart is that when financial conditions tighten, we tend to see stocks underperforming, going down. And that all kind of reached a climax a couple of weeks ago with really panic selling, just very aggressive selling that we track at MAPsignals. We track institutional money flow. And historically, when the financial conditions index gets spikes up, stocks spike down, that's been a good time to put money to work. You want to buy into that fear in the market that's being driven by higher interest rates, stronger dollar, and other things that are tightening conditions. We're using the Goldman index as a contrarian indicator, as a signal to buy stocks, along with a lot of other proprietary metrics that we track at MAPsignals, including our Big Money Index, which basically shows us when institutions are aggressively buying and when they're aggressively selling. In the last couple of weeks, we've seen some real capitulation by the big money, and generally that's when you want to be buying. The market's washed out, really aren't a lot of sellers left, and that's when we communicate to our clients they want to be in there buying. We made that call a week ago, and so far it's been working.
Yeah, we've got that graph of yours as well, the Big Money Index from your company. We'll bring that up. There it is. So how do you know that now is the time, though? Things could still, get worse from here potentially.
Right. Well, as far as the Big Money Index goes, we really track it, and it'll range anywhere from 0 to 100. And we basically want to be lightening up on stocks when we see readings over 80. And that's what we saw in late July when the market peaked. And we want to be buying when it gets very oversold in the mid-20s. And that's where we are now. So we basically use it as a market timing tool, as a contrarian type of indicator. And as far as things getting worse, I think the nice thing about panic selling and a lot of negativity in the market is that whatever happens going forward, no one can predict all the twists and turns, but whatever happens is likely to be better than expected when people get as cautious as they've been lately. I mean, you can look at areas like consumer staples, utilities, real estate. These are all some of the more defensive parts of the U.S. market have been absolutely hammered over the last few months. We've seen some unprecedented selling in some extremely high quality defensive companies. So stocks are very washed out. Our favorite sectors are tech and energy. They've held up better. But outside of those areas, U.S. stocks have really been hammered, and we think they're poised to do better through year end.
Alec, I understand understand that you think right now, I mean, as long as you're buying, it doesn't really matter what you're buying. So does that mean that you could buy an index fund, say, or do you have to still look, at a more granular level and you're thinking stock by stock?
Well, at the very least, when stocks get this oversold, we want our clients to increase exposure to equities. So buying something is better than buying nothing at all. And VOO is the Vanguard ETF that tracks the S&P 500. There's nothing wrong with that choice. We think clients can do even better, can optimize that by looking at our favorite sectors, which at this time are energy and technology. And those have really been in the 1 and 2 spots all year long for us. So that's how we would play it. We would definitely take advantage of this volatility, of the fear in the market, buy into it. And then if you're able to do something beyond the index, we would be looking at tech and energy.
Okay.